Hey YouTube, this is Leo with DRIPCalc, and in this video I want to talk about dividends and primarily what they are and expand on some concepts such as compound growth and compound interest and why dividends are better than investing into high yield savings accounts and treasury bonds and whatnot. Basically, this is going to be a very beginner oriented video, and a lot of people already know what dividends are. However, and you would be surprised, a lot of people don't know what dividends are, and that's why I want to make this video. So basically, the reason why I'm making it is I have these friends. They're about 10 years from retirement, and they're making decent money. You know, they probably have 401ks, savings accounts, but they don't know what dividends are. You know, they grow up in the United States, they heard of dividends, but they don't really understand the concept. So in this video, I want to explain what it is. I will also go into a topic of so-called dividend snowball, where your dividend investment starts to grow exponentially the longer you're invested in the market, and visually show you the benefits of it. So with that said, let's begin. And a quick public service announcement, guys, please smash that like button, subscribe to the channel. It really helps the channel grow. I'd like to get to at least 50 likes on this video. We're a young channel, and any help will go a long way to help promote our videos and help YouTube show it to more people. So with that said, let's begin. So what are dividends? Essentially, a company, let's say it is Coca-Cola, they make profit, they make money. So here's their revenue. They earn in revenues. This is not pure profit. This is how much money they have coming in, 11 billion a quarter. And then their net income is $3.18 billion. So what do they do with this money? And here you can see their cash and debt pile. So they have about 35 billion in debt and about 17 billion in cash. So what they do is they pay dividends from the money that they have collected. Now, of course, they can pay debt, but they do a little bit. They sometimes borrow more money, but they pay dividends. And here is their dividend payment history. And actually, Coca-Cola is considered what's so-called dividend aristocrat or dividend king, because they have been paying dividends for longer than 50 years, and they've raised the dividend every year of those 50 years. So they're a dividend king. And going back onto what dividends are, basically they take a portion of their profit. So let's say they've earned 74 cents per share. Okay, 74 cents net income per share, that's EPS. And they pay out a dividend of 48.5 cents to the shareholders. And that is about 60% of their net income. Now over here, I'm not sure why it shows 3. But they pay about 60% of their net income as dividend. Because if you take 74, actually, if you take 48.5 and divide by 74, you get 65.5% payout ratio. Anyway, so they take the money that they have earned in a quarter and they pay it out to the shareholders as dividends. And what happens is every year they actually increase their dividend payout amount. So you can see here, they're paying 48.5 cents, and last year in 2023 they were paying 46 cents. In 2022 they were paying 44 cents, and in 2021 44 cents. In 2022 42 cents. In 2021 41 cent in 2020, so that's the first COVID year. 40 cents in 2019, 39 cents in 18, and so they raise it every quarter because they earn more money every quarter. Let's take a look at their net profit, net income per share. You can see it is growing steadily, and so they can afford to pay out more dividends. Okay, so that's in a nutshell dividend. Now, there's a lot of people that say dividends are bad, and I'm not going to go deep into why they say that. That's not the point of this video. Basically, companies that earn money, they pay out dividends. Let's take a look at Citibank. Here's their dividend payment history. If we go all time, here they were paying a lot of dividends before great financial crisis. Then they reduced it to basically 1 cent, and for the longest time they were paying 1 cent, and then as the business improved they started increasing dividends. So that's a bank. Let's take a look at McDonald's. Also, they're paying dividends. They've been paying them for a long time. So they take portion of their profit, net income, and they pay it out as dividend. Over here in 2007, beginning of 2008, they cut the dividend. I do not know why. I didn't follow McDonald's that closely, but you can see ever since then they've been increasing it steadily and significantly. They've increased it over the last 10 years on average of 7.5% per year, and in the last year they increased it by almost 10%. Okay, so I think we understand what dividends are. It's a portion of the profit that is distributed to the shareholders by the corporation. Okay, now a lot of financial advisors say that it is better and safer to just invest in high yield savings account or treasury bonds, and in this video I'll show you why they are incorrect. Now what I want to tell you right away, what I'm showing in this video is not financial advice, but it is purely for informational purposes only, and I'm not telling you how to make your investment decisions. I'm just showing you the facts. Okay, so here is our compound interest calculator. You can find it over here. If you hover over home link, you can get compound calculator. Okay, and so let's say you invest $10,000 into a high yield savings account, and let's say you do it for 10 years with a fixed price or APR rate of 5% per year. So in 10 years you will have earned $470 in interest. And the way it works, basically your money compounds. So the first year you earn $500, a little bit more in interest. Here you can see interest in the first year, $511.62. So why is it not flat 500? And the reason is because it compounds monthly. Right here you can select your compounding. If we choose yearly or annually, it will actually change to 500 here. But because every month you get an interest payment, and then you have, in the first month you start with $10,000, then at the end of first month you collect about $40-something in interest, and now you have a larger sum of money earning interest at 5% rate, and so your second payment is actually a little bit higher, and so on and so on. And so by the end of first year you have collected $511 in interest, and after 10 years your total interest collected is $6,470. Now this is great, but the problem with high yield savings accounts is that right now we have high interest rates. Okay, so if you look over here, this is the federal funds rate, and you can see right here the current federal funds rate is 5.33%. Now it's actually a range, it's 5.25 to 5.375, so the average is 5.33, and it's a little bit less than what you would get from a high yield savings account, and the bank makes different money on the difference between Fed funds rate and what they pay you. And also they pay you actually not in APR but in API. So APY rather, is actually how much you will earn at the end of the year. And so if I'm actually going to adjust it here to APY rate, and then at 5% you will actually earn 500 flat at the end of the year. But that doesn't matter. So what happens is, because we had high inflation, the Federal Reserve raised the rates very fast. Over here, within a year they raised it from virtually 0 to 5.33%. However, now that inflation is subsiding and the unemployment rate is rising, and they're saying soon they will reach their target of 2% inflation rate, they are expected to drop rates. And so if we look at September of this year, they're expected 94% chance that they will drop it by a quarter of a percentage point, 25 basis points, and then a year from then they're expected to drop rates to about 3.5 to 4%. So they'll reduce it by about 1% and 1.5% from the current rate, or 1.375%. Okay, so and then what will happen after that? They'll keep dropping the rate, so your high yield savings account will not consistently pay you 5% throughout the whole 10-year period. This number will actually go down, and if we do not have another massive inflation, most likely the federal funds rate will stay somewhere around 1 to 2% range, maybe 3, but you would be getting about 2.5 to 3% at the most on your high yield savings account. So if we change this to, let's say, average rate of 3.5 throughout the next 10 years, now this number drops significantly to $4,183. Okay, and you can't expect to have a 5% rate, because this rate is not fixed. It is variable APR or APY, and it changes with the Fed funds rate. So even if you get 3.5%, that would actually be a pretty good outcome, because if we go back to here, between 2009 and 2015, you were getting essentially 0 on your savings accounts. And over here in 2020 until 2022, you were also getting about 0% on your savings account. So you can't expect to have 5% for the next 10 years. It's impossible. Now, next thing is treasuries. And of course, treasuries are a fixed interest rate. However, a 10-year treasury is about 4 and 4.25 right now. So let's take a look. 10-year treasury yield right here, CBS. Let's see what it stands. Yeah, exactly 4.25%. So if we go back to compound, now this is a fixed rate. You actually guaranteed that rate for 10 years for 24.5. Am I correct? 0.2. Okay, whatever. We'll use this number. And so with the fixed rate, you will have collected after 10 years $5,277 in interest. However, if you take let's calculate dividend yield of the Coca-Cola company for the next 10 years. Now, Coca-Cola is known to raise their dividends every year for the last over 50 years. More than 50 years, they raise the dividend every year. So unlike the interest rate on your high yield savings account, your dividend rate, or dividend payment rather, will actually go up. So if you invest $10,000 in Coca-Cola today with the current dividend payment, and this is the growth rate, 4.75% increase per year average throughout last 10 years. Let's calculate that. You will end up with $37,000. No, this is incorrect because this is actually investment of $100 per month. So let's clear that out. You'll end up with $19,913 total value. Your dividend collected by then will be $4,338. Okay, that's a little bit more, a little bit less than the interest you would collect on a treasury, which it's about $1,000 less. However, let's go back to this calculator. Now you're affecting yield on cost because we invest $10,000 in the beginning and we do not add anything. You see, this is zero. Extra investment is zero. Your yield on cost in 10 years will be 6%. Whereas the treasury, that's it. The treasury expires, you get your money back, and you will have collected interest over this time. And now the total return of investing in Coca-Cola is significantly higher than even treasury. Now, if we go back to a high yield savings account, again, as I said, there's almost no chance you will have consistent 5% over the next 10 years. And if you do, that means we have really high inflation. So if we have 3.5% consistently, you have earned the same amount of interest. However, the benefit of investing in Coca-Cola, for example, is that your share price also grows over time. So let's take a look at Coca-Cola report right here on our website. You can see the total return over 10 years. If you invested $10,000 in this company 10 years ago, you have received 111.5% total return if you reinvested your dividends. So the beauty of dividend investing is the so-called snowball effect. And that's where you take the dividends that you collect. Because again, we're doing the same thing in a savings account or not in a treasury. By the way, on a treasury, you will likely collect less because unless you actively reinvest your interest back into treasuries, you do not compound. Actually, this has to change. And I'll do a separate calculation, but it's very easy. So you take 10,000 multiplied by 0.0425. Again, it's not compounding, and you earn $425 per year. You multiply it by 10, and you have collected $4,250 in interest. If you don't reinvest this money, this is what you end up having. Okay, and in a savings account, you actually compound because now your cash balance increases, and so you are paid interest on the cash balance. Therefore, your money compounds, but not with the treasuries. So back to Coca-Cola. The dividends are reinvested back into stock the same way as your money is now, your interest is earning interest. That's the beauty of compounding. Same way with Coca-Cola dividends, you reinvest back into the stock and you end up with more shares at the end of the 10-year period. So here you start with 153 shares, but after 10 years you have 201 share. Okay, and also the share price goes up. So now you can sell your shares for about 30% increase, or actually no, it's almost 50% increase. And now your yield on cost is higher. And so you end up with $19,913. So it's better than either treasury or the high yield savings account. And again, as I said, most likely the interest on the savings account will drop to about 1-2% range after 3 years. And so even having getting an effective rate over 10 years of 3.5% is very unlikely unless we have a high inflation. But let's go further. Let's change this to $20 20 years. Okay, so after 20 years, you have collected $10,117 in interest, and let's even change it to 5%. Why not? Change it to 5%, calculate. Come on, calculate. All right. You have collected $70,126 over 20-year period. And this is compounded. And you are not adding anything to your account, just the interest compounds. Let's do the same thing for Coca-Cola. Again, we're not adding any funds monthly. We just change this amount of this period of investment to 20 years. Click calculate. Okay. And so after 20 years, you're expected to have almost $42,000 value, portfolio value in Coca-Cola, and the dividends you have collected, total dividends are $13,707, and now your effective rate, you know, the how much money you get on your initial investment of $10,000 is almost 13%. It's almost unheard of to have 13% yield on a quality stock that's almost guaranteed to increase their dividends every year. And Coca-Cola is not going anywhere. However, guys, Coca-Cola is a very slow dividend grower, and the stock also grows rather slowly. If we go back to stock details, let's take a look at the share price right here. So over time, they barely grew from 1998. They were like almost $44, and now almost 30 years later, they're sitting at 65. And actually, for a while, they've dropped significantly to below like $19. They did grow their dividends, but all of it is very slow. So they're growing. The share price is growing by 4.4% compounded increase rate over the last 10 years. And their dividends are growing a little bit faster at 4.75% per year compounded over the last 10 years. Now let's compare this to, for example, McDonald's. So here I have McDonald's stock. Now they did have a golden arches pattern where the share price arched and arched again and now is at the bottom. What this means? Actually nothing. It's just a funny thing. But they also increased their dividends, except for like this weird thing right here. I need to do some research into it. But if you invested $10,000 into McDonald's stock 10 years ago, you are up 240% since then with dividends reinvested. So this is a very good return, on par with S&P 500. And as Warren Buffett says, if you don't know what you're doing, just invest in S&P 500 fund and you'll outperform 99% of fund managers and hedge funds out there, which is completely true. If we look at SPY, so over last 10 years, actually McDonald's beat SPY over last 10 years, which is funny. But so SPY is an S&P 500 ETF, and they're also growing their dividends over last 10 years. Now this is more sporadic because it's an ETF. It's a collection of different companies that pay varying dividend amounts, so it's all over the place. But let's say there is a fund called SCHD, and it is a dividend fund. And so let's calculate dividends for SCHD, and now we're talking about Dividend Snowball. So SCHD, they're growing their dividends at a very rapid rate. You can see right here, over last 10 years, they increased their dividend on average by almost 12% per year. So this is a really good compounder of the dividends. You can look here, it's going up and to the right, and the yield of the SCHD fund is also going up. That means that the dividend growth supersedes the share price growth. So you're collecting more dividends every year, and the dividend amount grows faster than the share price of the company. That's your yield. You can see it's going up ever so slowly, but over here 10 years ago or 12 years ago was 2.85, and right now it's sitting around 3.66. So it's a really good dividend grower. Now again, this is today's price, the latest dividend. However, I think this year their average dividend will be, let's say, 77 cents. Let's calculate at a lower dividend amount because that's more realistic. So after 20 years, you'll end up with you should end up, now this is not guaranteed, but based on previous performance, you should end up with $120,000. Now again, let's compare it to Coca-Cola, where you end up with $42,000 with the CHD. You're expected to have $120,000 at the end of 20-year mark. Again, we're not adding any amount here. And your total dividends collected over 20 years will be $52,500. We'll go back to compound calculator, guys. Even at guaranteed 5% compounded rate, you still end up only with $27,000 after 20 years. So a CHD would probably be the high yield savings account or a treasury by about 5-fold. And if you look at the 30-year mark, now this is a real dividend snowball. What is snowball? Every year you reinvest your dividends, and then your next dividend payment is higher and higher and higher. And look at this hockey stick. It just goes up and up and up. And by 30-year mark, you will have collected $350,000 on your initial $10,000 investment. And your total portfolio value will be $625. Now, again, this is approximation, straight line approximation, but after 30 years, your yield on cost, so how much you make on that initial investment of $10,000, you'll be making 631% per year, or $63,000 in 1 year just in dividends. So that is the power of dividend investment. And again, dividends are the money that corporations pay out to their shareholders in excess of their net profits. Now, just a brief touch on the idea that dividends are basically a waste of money for the corporations. It is in a way, because maybe the corporation can reinvest that money into growth, into like doing a project of some sort, and they can earn more money from reinvesting the funds instead of giving it back to the shareholders. However, back to Coca-Cola, like, where is Coca-Cola going to invest money? They've been around for over 100 years. They've paid dividends for almost 100 years. They have competition. There's very little growth. As you can see over here, let's look at the growth of revenue for Coca-Cola. Now, they're going out of their way to grow the business. However, 10 years ago, their revenue was higher than it was last quarter by a pretty serious amount. Let's take it all time. You can see here. So we have history since 1985. So in 39 years, they've increased their revenue by fourfold, 4.5 times. Over 40 years, that's nothing, guys. And unfortunately, Coca-Cola doesn't really have any avenues to reinvest that cash. So what they do is they pay out dividends and they buy back shares, albeit very, very slowly. You can see here 10 years ago, they had 4.45 billion outstanding shares, and today they have 4.32. It's a very slow buyback pace, and they basically buy back an average of 0.3% per year over the last 10 years. Okay, now, why do I say that Coca-Cola will not grow tremendously? These are the estimates from the Wall Street analysts. So going into end of 2026, so 3 years from now almost, they're expected to have about the same revenue as they are today. So 11.3 billion in the last quarter, and they're expected to have 11.81 billion revenue in 3 years from now. Now, their EPS, or earnings per share, is expected to increase. And you can see here the last quarter of the year, they have the lowest EPS. I'm not sure why. Maybe they put Coca-Cola up for sale, like they run sales on their products, whatever. But they're only in beverage business. They do not have chips or, food products. They only have beverages. And their competition, Pepsi, is actually also doing food products. Not fast food, but snacks and whatnot. And so they're growing faster. Let's compare Pepsi to Coca-Cola. This is our stock. So here we have 10-year returns for both Coca-Cola and Pepsi. And you can see Pepsi has returned 150% over the last 10 years, which is less than SCHD, by the way. So if you search SCHD, their return is 187%. So significantly more than Pepsi-Cola. But let's go back, Coke versus Pepsi. Pepsi, or Coke, returned 111.5%. And you can see this red line, that's PepsiCo. And they're growing significantly faster. And as soon as that 10-year period began, they were ahead of Coca-Cola because they have more products, and they actually are increasing their business coverage, so to say. They're branching off into different products, they're trying other things, and therefore their returns are higher. However, even Pepsi-Cola does not have a lot of growth, and we can see here revenue for both companies right here. So here's Coke. Again, over the last 39 years, they increased it by 4.5 fold, and Pepsi-Cola grew it significantly more, from 2 billion in the same year, same quarter, up to 22 billion. So right now the revenue is double that of Coca-Cola. And but even though they increased it by tenfold over 39 years, it is still, in the last 10 years, it's less than 3% compounded growth. So that's nothing. And just for comparison, let's not even look at Nvidia, like, it's the king. But let's take a look at Microsoft. Company has been around forever. They've been selling Windows and working with CrowdStrike, and then all the things stopped working. But if we look at Microsoft revenue, going back to the same years, they started with 42 million, and they're up to 61, almost 62 billion dollars per quarter. But let's take a look at a 10-year mark. So 23 billion 10 years ago, and 62. So in just 10 years, they tripled their revenue. Whereas Coca-Cola, right here, over 10 years, they have increased their revenue by what? 20% instead of 300%. So yeah, companies like Coca-Cola, they do not have much growth, and that's why they're paying out their money, their revenue or net profit, to the shareholders in form of dividends. They just can't reinvest that money fast enough, and they're doing minimal share buybacks. But if we look actually at Pepsi, they're buying a lot more shares than Coca-Cola, 3 times more. Still a very low amount, just 1.05 compounded rate over the last 10 years, but it's 3 times more than Coca-Cola. And if you look at projections for Pepsi-Cola, go out really far. We don't have any actual revenues here, but so they're projecting by end of 2027 there will be at 34 billion. So we have to actually go here. Last quarter was 22.5 billion, so that's 50% increase over 4 years, which is pretty nice. However, Coca-Cola is not expected to grow nearly as much as Pepsi-Cola. All right, guys, so that's just a basic concept of what dividends are. Now, companies like Microsoft, yes, they're better off investing into business, buying other businesses, buying other companies, developing new ways to make money, which is what they do. And if we look at their return on capital employed, it's pretty good. It's pretty out there, 7.5% and 7% return on invested capital. So that's not bad. If we look at Coca-Cola, where's Coca-Cola? So their return on capital is less than 3%, and return on invested capital 2.6%. So Microsoft is earning 200% more for every dollar they invest compared to Coca-Cola. And so Microsoft, it does pay dividends, and they grow them pretty rapidly. Where is our Microsoft? MSFT. So they grow dividends at 10.5% almost over the last 10 years. However, because the share price is going up so rapidly, their dividend yield is dropping, and it's now less than 1% yield. So investing in companies like Microsoft for the dividend is maybe not such a good idea. You basically invest in growth. And that's a whole different topic, but essentially dividend payers are usually the companies that have very slow growth, and they are there is no way for them to grow faster in most cases. Therefore, they distribute the cash they generate to their shareholders as dividends. And if you invest into a dividend stock or a dividend ETF for like Schwab, SCHD, you will have over time a pretty decent return on your money, much better than Treasuries and much better than high yield savings accounts. So with that said, guys, thank you very much for watching. Again, smash that like button, subscribe to the channel, that will really help us grow. And if you want to use our visual stock research tool that we have here, DRIPCalc Pro, we're offering a 2 weeks completely free trial. So if you don't like it, you can cancel at any time. And also for our YouTube subscribers, a 30% lifetime discount. So even when we raise prices in the future, your price will remain the same, and you'll have full access to all our tools, the stock research tool, the stock compare tool, ETF tools, and many other tools that are coming out shortly. So give it a try. We'll put a link in the description below, so you can use the promo code that will link there and try it out completely free for 2 weeks. If you don't like it, cancel anytime. Thanks for watching, guys. I'll see you in the next video.